Welcome to Educational Alpha. I'm Bill Kelly, CEO of CIO Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly is joined by Kevin McCreadie, CEO and CIO of AGF Management. They discuss the evolving landscape of asset management, focusing on the challenges and opportunities presented by market disruptions, democratization, and tax efficiency. Kevin shares insights from his extensive career, highlighting AGF's innovative approach to global investments and the importance of tailored financial products. The conversation explores the significance of active management, the need for better financial education, and the future of investment strategies in a changing economic environment. Listen in.
Kevin McCreadie, welcome to Educational Alpha.
Bill, thank you for having me today.
I've met a couple of your colleagues up in Toronto a couple of weeks ago and learned a little bit more about AGF. Very interesting model. And I think I want to spend the bulk of the time talking about how does a modern day asset manager position themselves for what has been and will continue to be a period of disruption around products, around distribution channels, around democratization, around wrappers and tax efficiency. And we're going to cover all that and maybe more in 30 to 40 minutes. But you've had a very interesting career. A lot of it as a CIO. You're now wearing CIO and CEO hats at AGF, but you also have straddled both sides of the northern border as well. And it seems like you started your career in the U.S. So maybe a little bit on your background first, and then we'll get into the structure of the asset management industry circa 2024.
Yeah, no, thanks, Bill. I grew up as a classic, the way you started in this business, analyst to PM. And somewhere along the line, people thought I could manage people. So I got bigger responsibilities. I became a CIO in 2002, which was probably not the easiest time to become a CIO. If you remember what was going on, we had just come through the wreck of the tech bubble bursting. You had then rolled into 2003, which was the U.S.-Iraq war. So we had a few things going on when you're a new CIO. And then literally transitioned out of the U.S. to a similar role on a broader platform or a global platform with AGF in 2014. But I've started my career in the industry in the early 80s. So I've seen a lot, both from the narrowness of being an analyst and PM to the broader macro side of things as a CIO.
And then just as we move then into your current role at AGF, just maybe a quick thumbnail on AGF. I know it's been around for many, many decades, but it is a public company as well, as I understand, but a little bit of background, including maybe the AUM and a little bit of sizing.
Yeah, we're about 50 billion of AUM. We consider ourselves a pretty good, unique boutique asset manager, mostly global things. To your point, we have been around 67 years. And in an industry where sometimes we don't think it changes much, I can tell you over 67 years when we look at the history, we've had to change a lot of times. We've had a history of being the first and an innovator in many things. The actual firm name, AGF, stands for the American Growth Fund, which was the first fund for Canadians to invest in U.S. securities in Canada. And over that 67 years, we've had a number of product firsts, regional firsts where we have been and played. And so, yeah, the history of the firm is rich. We've been a public company for 55 of those years and one of only 30 that have that longevity within Canada.
Ancient history to some degree, but if it was 55 years ago that you went public, I don't know what your AUM was back then, but that must have been a reasonably small-sized market cap. One observation. The second observation, and you and I have been around long enough that these businesses never required capital in the good old days. Very, very different today, but the operating leverage was high. 2 people in a Quotron, you were good to go. So you really did need external capital. So what was the impetus 55 years ago to go public?
I think it was to grow. We were small back then. And if you go back to that point in the history, you could have gone public at a very small size back then, and you were small cap and grew into bigger shoes. But it was to be able to use that capital to grow. You fast forward probably a couple of decades. Small Canadian asset manager then had offices in Dublin, Singapore, Beijing. So that required some ability to draw more capital. And today, as I've said, we do things that are mostly global. It is a little bit more expensive on that side of the world, but you're absolutely right that we think about these businesses that I call them as they should be less capital intensive. And you look at our industry, the capital we deploy today is in things like technology and all the things we're all focused on in terms of productivity, the things around security and cyber, et cetera. So there is some element of it, but that's more SG&A than true needing of external capital today.
And it sounds like for a firm of your size back 55 years ago, probably the exception rather than the rule to being as global as you were, that the boutique model is really what drove it. And you either were in maybe one or two markets, but very few would have the office components you just mentioned so early in the cycle. Was that client driven, or is that where the portfolio management teams were? A little bit of both?
A little bit of both. I think that the founders had great vision about the global world. And if you go back to Canada, in many of the pension regs back in the 70s and 80s, you were restricted to how much you could have outside of Canada as an asset. If you were a Canadian pension fund, you had to keep most of your assets in Canada. That's changed a lot. The thing I think that's, frankly, to the end investor, the Canadian, take the retail investor, has always had a more global allocation. They didn't think of the S&P 500 as the core piece of their portfolio. They didn't have access to that. And the comparable to TSX was something that looked very different than the S&P. So you ended up with people earlier, I think, taking a more global view from an asset allocation standpoint, which led us to some of those decisions as well.
And now maybe we can get into the current model and what you're trying to accomplish both as CEO and CIO, which are very complementary, but maybe a sometimes competing pair of hats too, because you're approaching it from two different ways. And you have shareholders and clients you have to be focused on as well. But if I look at the backdrop of where we are in the marketplace and where things are going now, maybe just 10 years ago, the traditional asset management firm really defined many, many firms, and all still alternative investments are still less than 20% of the global AUM, but is driving a big fee component. So you have this movement away from just a 60-40, and I reject the notion that the 60-40 is dead. But if you can have access to more uncorrelated risk premium, why not find a way of doing it? But then we have this concept of democratization as well, where maybe a U.S. phenomenon, maybe there's an equivalent in Canada, where the defined benefit promise does not exist anymore. And we as individuals are responsible for our own investments, which is a very challenging task. And to then allow us only access to the public markets is not a very good answer either. So the challenges of being in your seat today versus 10 years ago, maybe aggressive to say dramatically different, but from my vantage point, I think that they are. As you think about your clients and your performance and your shareholders and having a business model that sustains into the future. So, and I know you're doing some things around the evolution of the business model, which we can touch upon, but as a broad thesis, how are the challenges and how are you dealing with them?
You mentioned you just came to visit us in Toronto to our new offices. So we had been in our old offices close to 50 years. Only been there closing in on 10 this year. But moving, I'm one of those pack rats. When I read something that I love, I stick it in a file. And so I had the ability to move to cleanse a lot of my old things that I'd highlighted and written. I pulled out a piece of research, and I forget which house had done it. It was dated 2004, and it was the death of our industry. And if I hadn't read the date on it, I would have thought it would have been written yesterday or a year ago or 2 years ago. So we have had this narrative out there about our industry and this change, whether it be from the large consulting houses putting out their view of the future for a long time. And it's changed at the margin. The things around us inside our industry have changed dramatically. The vehicles we use, things like ETFs here in Canada, share classes of ETFs from a fund, much more active. The technology we deploy. But the death of the industry has been a bit premature. I think all of us who are industry participants, it's incumbent on us, though, is to think about that disruption because it has happened. And you have many firms that have gone away. You've had many firms consolidate. We all know the names, but take two large firms, both in outflow one and less outflow, and you put them together, and the combined firm maybe looks a little bit better, but there's still an outflow. And you have to ask yourself, when you do that, is it just a cost play then? Or have you done something from the product and distribution lens that can change your outcome or / outflow that you've been in? I'd say that has probably been the biggest thing that we've seen in the last decade is consolidation. And I don't look at many of them and say they make a lot of sense when I look at them. I'd say the second thing over the last decade, when in the view that you might have been referencing, is that you either had to be trillions of dollars to survive, and there wasn't a place for people below that. I think where the businesses have changed is you get stuck when you're in the hundreds of billions and have to be everything to everybody everywhere in the world with every vehicle. That gets challenging. Where I think the attractive opportunity, so at the end of the scale, you can be really, really big, the guys with the trillions. Small basis point changes in the underlying vehicles kill them, though, when you have that much. Or you can be in the place where we are, where I think the boutiques live in the couple of $100 billion and lower that offer very targeted, differentiated product that tries to stay ahead of the curve. And I'll give you one quick example. As a more globally oriented firm, we have tried to take our retail business, which we do really well in. Everybody in the U.S. is stunned by how well we do in terms of positive flow, and narrative is nobody buys funds anymore. That's actually really not true. But our end, we've chosen years ago not to do things that our end investors can do themselves. Why give them a Canadian equity fund when they can manage Canadian equities? Why actually give them just a U.S. fund? Because many of them think they can do that well too. So we give them more things global, harder to do, harder for them to individually do, more innovative things. And so if you take that kind of an approach, I think that allows you to grow versus just trying to be everything to everybody with every vehicle everywhere approach. When you have too much of that, I think it becomes really challenging. And I think you've seen some of the people who've gotten to that place where they're stuck. They can't be more niche-y and they have to be everywhere. And I think it gets to be a challenge. Probably last comment, Bill. I know that was a lot there. This is also still about, I think we all forget about it, but a lot of this is driven by pretty simple basics of our industry. Can you provide product performance consistently that is differentiated, that maybe correlate differently for someone when they put it together with something else? Back to basics.
And I think maybe hammering home that point, a size can be an advantage until it's not anymore. And if I think about where the inefficiencies are, it's in the smaller, medium cap part of the market, even in public markets. And I think it's certainly true in the private markets, where mid-market, I think, is much more interesting than buyout. So I think that we're starting to see a lot of acquisitions and mergers, and the bigger getting bigger. And if it's a distribution play, maybe it has some resonance. But I think trying to be very good at the part of the market where you think you can add value can be a tremendous strength. And it seems like that's a hallmark of your model.
One of the things we did, so let's use some of the phenomena around the passive side of the world that has probably uplifted and shook the business, our industry for the last 2 decades, which is indexing. And so we know that it's a phenomenon that's much more prevalent actually in the U.S. than what we've seen in Canada. Canada is still very active in terms of that. We have a growth of passives, but it's nowhere near what you've seen in the U.S. in my experience. What that led us to is saying, okay, let's not take a very diversified approach to offering a U.S. equity product. Let's take a 30 stock portfolio, something that is concentrated, that gives alpha around that when you bolt it onto that passive piece. Can we do a 30 stock concentrated global portfolio that someone who wants to use an equity index can bolt that onto to add alpha above the index? And so that's, for a firm like us, when we look at that change, take the dynamic that's out there, don't run away from it or let it run you over. Run to it and think how you can add something to that lets you grow, which is when you look at where we've had some success on that, it's been adding to this passive regime, these concentrated portfolios. People can get, when you put them together, better outcome, both from an alpha as well as a Sharpe ratio standpoint from risk. That's probably one of the changes. I'd say the other change that we've seen here, and we try to stay in front of it, is think about our end client and what they want. Increasingly over the last decade, and you referenced it earlier, the 20% maybe globally that has been put into this private world. We know that the end individual investor is going to need some of those same tools. They may need more liquidity than maybe a classical pension fund. But we know that that asset allocation preference is changing. How do we stay in front of it? How do we start to shift the firm to basically add more of those capabilities in the same vein? So as the end investor comes along, we have a product array then in this broader bucket of things called alternatives that have varying degrees of liquidity that can give a better outcome from an asset allocation standpoint.
What are the rules for an accredited investor in Canada? Are they similar to the U.S.? You have to be qualified to move into an alternative offering?
Yeah, we have very similar accredited investor rules. We have actually a different set of rules from a regulatory perspective of how much could be bucketed within advisors' mix. That is, so the regulator basically says you can have this much in conservative assets, and I'm using broad terms, and then these are risky assets are limited to this. Alternatives have a cap on how much an advisor theoretically can have in a client's mix. Sadly, when we went into 2022, the bond portion of the portfolio was classified as, quote unquote, the safe and defensive part. Some of us in the industry could look at that and say, I'm not sure that was actually a good assessment from a regulatory view when you had 10-year bond that in 2022 at one point was down 23%. A lot of end clients still, not sophisticated pension plans, but end retail investors don't really understand bond math the way we all do. So I think we have to change some of the definitions around what an advisor can do and change that asset allocation buckets to widen them. I would make the case that certain alternatives that are classified that use derivatives, for instance, are in this high risk bucket. They actually mitigate risk. They hedge a portfolio. So I think there's a big rethink on the regulatory side. But the two, from what an investor can buy from an accredited lens, is not that different. The difference is really the regulatory lens at the advisor level of how much can be in these different buckets that is more wide open in the U.S.
Broadly speaking, Kevin, maybe not so much AGF, but your views on how well we've done educating the prospect or the end client on two fronts. Maybe first off, do they truly understand the concept of taking risk? Because you have to. Stuffing your cash in the mattress is also a decision and has risk now with inflation sustaining where it is. But once you take that risk, you want to be fairly compensated for the risk you've taken. And then secondly, and maybe it ties in the concept of long-termism. And if we want, and I think we have to find a way of giving investors greater access to the private markets, it's not so much being compensated for an illiquidity premium. It's paying to get access through due diligence to a part of the market that is more opaque and more difficult to access. And once you've done all your homework, to insist on a way of getting out every quarter does not seem to strike the right balance. And if the starting point is that if this part of your portfolio is matched against your retirement happening 40 years from now, don't worry about liquidity. And here we can take some of those assets and bring them long term. So I think in a conversation, these are pretty simple concepts. But as an industry, I don't know if we've gotten off first base in terms of getting this through the hearts, minds, and souls of the client.
Yeah, I think you just touched on something. You said the word education. It's so funny because literally a call I was on an hour ago, we talked about this issue. There is a gap. We at the industry think we're doing it. We may be doing more product knowledge than education, and education has to come first. I've seen some very large firms in the U.S. this week do an advisor university for massive amounts of advisors with a group of alternative shops. Really not around product, all of it around education. So that is part one. I do think it's incumbent on all of us to grow this asset class for the right reason, because it does good things from a portfolio construction standpoint. But we got to get to the education. I think we're still in the early innings of what that looks like. Some, I think, will have the advantage of doing it, and they may think they're doing it well, but they may be really doing product knowledge, not true basic investor education. So I think that's one that's with us for a while. I'd say the second point about your liquidity, I think you're absolutely right. If you're going to be have a long-term view of things, you should not worry about that liquidity. I would also argue there's a wealth quotient in there. The larger portion of your wealth that you have, you could have higher allocation to things that are more illiquid because you can sustain any downturn from how do you run your lifestyle, et cetera. So there is some of that. Having said that, I also worry about the fact that the mass affluent folks who can't actually accept a drawdown in a large sense, those are the ones who actually you need to protect more and don't have the availability of those vehicles, products, or that understanding to protect them. Versus someone who's in a mega family office situation where a couple $100 million, they can have an awful lot in alternatives and they're going to get defended really well in a tough market. Whereas a person who is really saving for that next 5 years and about to retire, doesn't have access to those vehicles and is stuck in the classic 60-40 scenario is really get pained. I think that dichotomy is something we have to fix as an industry. How do we bring the best thinking to all investors? Maybe different wrappers, but the smallest person who can least afford it shouldn't get a worse outcome than the largest who can.
That all makes sense to me. Going back to something you said earlier, Kevin, and maybe I inferred this correctly or incorrectly, but it seemed like your starting point for adding more product is what does my client want and need, and how can I extend that across and continue to add value? Is part of that narrative also what the prospective client might need? So if you've got more of a retail base, and I don't know if that defines AGF or not, but less in private wealth, is that an area where you wanted to grow your business and offer solutions there as well? So how do you differentiate retail versus private wealth versus high net wealth? And then how do you think about solutions for those various different client sets?
If you went back to our beginnings 67 years ago, we were a fund company. And if you fast forwarded to late 90s, we had basically made the decision to start to diversify away from that. And partly because of this fear, even back then, that the fund industry was going to change. Today, if you look at us, we're only half of our assets are in retail funds, which we do quite well. We're one of the few that are in growth there. But now, today, the biggest next chunk of things we have is really larger institutional partners that we provide product to. The end client there may be somebody's retail client, but we're providing product to, think of it as some large gatekeeper with great due diligence capabilities that looks like a pension fund that happens to distribute to others. And we do still do classical institutional work as well within that bucket. We have a smaller private client business of our assets. It's just sticky. It grows nicely. It's a good anchor. It's about $8 billion of our assets. So we've tried to think about our channels that we provide product to differently. Within our retail segment, we look at the mass affluent as a great opportunity, especially in Canada, where we have terrific immigration. I know it's a word that, depending where you live in the world today, has a different connotations. Canada needs new entrants, and over the last couple of years in the G7, we have the highest immigration rate, almost close to 4%. So think about those cohort of people. They come, they want a middle-class lifestyle, they want to save. How do we think about building product? Maybe balanced product, maybe a balanced product that has hedges in it, maybe that thinks about that 40% of the portfolio that's traditionally in fixed differently, that has within that ways to be more defensive. So we give that lower mass affluent client maybe a smoother ride versus the upper end of our private client mix, which can withstand more volatility. So again, we do think product, but it's really about the channels we're trying to serve, Bill, to your point. We don't try to do a one size fits all.
Maybe a couple of the points related to that, Kevin, as you think about, and this has been part of your offering, the more retail-oriented client, but I think there are a lot of large firms that are now tapping that space for the very first time. And a big difference between Yale's endowment versus Mr. and Mrs. John Q. Public is taxes. And I don't know if we spend enough time thinking about tax efficiency after tax returns. Certainly there's a move in the U.S. Be curious to get your views on this about converting 40 Act mutual funds into ETFs because it is a better tax answer. And then maybe as a related observation, and they tie together, have we done enough on outcome-oriented products and teach people in their 70s and 80s, if they've been a very good saver, how do they access this? And are there outcome-oriented products as opposed to throwing them a high-fee annuity product? And I'm not dissing annuities. They have their place. But I just don't know if we've spent enough time on the consumer who's done a very good job into the 70s to the 95. So both taxes and outcome-oriented products.
Let's start with taxes. We're living in a world where every developed country that I look at is running massive deficits. They can grow their way out of it to some degree, but we're probably living in higher tax regimes than we're all been used to for a long time. Taxes are going to matter and have mattered. There's a large amount of sophistication that's being applied to the industry in terms of some of the technology. So think of this today, not just the tax efficiency of an ETF versus a mutual fund, but we can deliver our capabilities, and we do in the U.S. quite successfully, to these large platforms that buy our alphas. So we give them our weights and our names every day. They're called the SMA business. A big distributor in the U.S., think a large wealth bank or wealth platform at a bank, can buy several of these SMAs, put them side by side. A client gets individual securities, and they run a tax-aware software over it. So you may have a loss in Microsoft. Over here, it says, show me a security that looks like Microsoft's characteristics, sell Microsoft, and buy that. 30 days later, you swap them back out. And the ability to have these sleeves allows you to cross over. using technology to create tax aware. So you're absolutely right. Tax efficiency is going to be important. It won't just show up on the ETF side. It'll start to show up in this SMA and tax law harvesting programs, which are going to become more active. So I think that's not going away, and it's not going away because I think structurally it's hard for me to see taxes going down anywhere anytime soon. Certainly in Canada, we're seeing capital gains taxes actually increasing to effectively now almost a rate that looks something like 30%. So again, it becomes more important, not less. Technology will have a big place in this. Tax-aware investing is going to become a theme as well. To the other point about outcomes, I do think there's a gap in the product providers. They think about a product versus a benchmark or a peer group. And we have target date funds for a long time, which existed, that have been tried to be outcome oriented, but they're really age oriented. Most target date funds they simplistically say, when you get to this part, you can take this much volatility and we'll make up for it by giving you more in fixed income. It's essentially an age schematic. An outcome is individuals at different ages actually may have different needs. And part of it goes back to how wealthy you are. You may need less income off your portfolio. If you have less assets, you may need more. And how do you balance outliving your portfolio? We're all going to live longer as well. So I'd say there is a need for what I call customized outcome portfolios, because not one size will fit all there. That too will be a technology solution. And you're starting to see some of that come to bear. But I think there's a long way to go there. And it's not just about, again, the product mix or asset allocation. It's maybe different products to get to those outcomes, and for each person differently for a different age bucket.
And we're not going to solve that on this call today, but Fink has reoriented the theme in his annual letter, and it's about rethinking retirement. I thought it was an excellent observation or set of observations in there, and even some things we can think about in terms of maybe a supermodel like the Australians. It's going to require innovation at the sovereign level, and I think that's going to be a challenge here in the U.S. But corporate America has pushed away from the responsibility table, and we've dropped a very complex set of challenges onto the big toe of the individual investor without a lot of help. And even the advice market in the U.S. and maybe Canada as well, it's pretty opaque and it's available for people of means. But the average person on the street, we can and should get the financial literacy higher than it is. But it's only going to get to a point where maybe they can ask more informed questions for their trusted agent. And I don't know what the advice market is like in the worlds in which you travel, maybe more specifically in Canada, but thoughts there about how we can do more to help the client make better investment decisions.
One of the things that's just pleasantly surprised me in Canada was the availability or accessibility of advisors to pretty much everybody. Everybody in Canada has an advisor. So we've made it accessible. Now, quality advice is going to differ in the channel it comes through. You don't see as much in the do-it-yourself investor channels here. So where you look at Charles Schwab and others in the U.S., where they don't even charge brokerage fees any longer. But that's an avenue that we have here, a do-it-yourself investor. It's clearly not the same as you see in the U.S. So I feel good about that from the standpoint of Canadian landscape. I do think there's an advice gap in the U.S. There's certainly one in the U.K., I think, post some of the regulatory reforms there. And I think that is unfortunate because where that advice gap shows up is at the bottom end of the spectrum of wealth, where I think that individual needs advice more than the ultra high net worth. And here we have this gap because it's not profitable if you can't do it with technology and other things. Having said that, I also would say that maybe if we were on this call 5 or 6 years ago, Bill, you and I would be talking about robo-advice and how it was going to change the world. And what we have found is that robo-advice, the actual technology that was going to be used, is now actually better used in the hands of an advisor to be more productive to deliver that advice. So you can serve more potentially lower profit clients. I still think there's a gap there for sure. To the other point about this change in the institutionalization of how we had our pension delivered. The old days, a defined benefit, which you can count on. Today, here's a 401k solution. You have to put money in, I'll match it. But you're on your own because I don't want to get sued. Giving you advice is really going to be where I get queasy if I'm the corporate in the U.S. So not only have we changed, I'm taking care of you from a maternalistic standpoint, from corporate America's standpoint, we've actually said, here are the tools. I'm going to try to give you what you can, but I can't get too much in the way. And I take it one step further, not to pick on the passive world that's out there. I've seen many large institutions basically say, not only do I want to give you advice, I don't want to get sued for picking the wrong managers that you have to choose from. So here you're just getting a bunch of index funds. And I would argue, I don't know, maybe when you get to places like where we are today in the world, where take the case of the S&P, I think is still, despite some of the Magnificent Seven having slipped a bit, even if it's the Magnificent Three or Four, 7 names probably make up 35% of that index. We've seen what happens when the market ultimately will broaden out. So the solution sets that the quote unquote employer gives the employee to do it yourself in this 401k kind of world, even they may be, because I don't want to take the risk, are suboptimal. So I do think both of these problems are going to have to be solved with some kind of a change in thinking about how we give advice across that spectrum.
Yeah, absolutely. And if I can contrast, I have moved a couple of times in the course of my career. So I've got an IRA rollover, and I have a lot of flexibility to do a lot of interesting things inside of that. But then in my Kaya 401k plan, it's 8, 10, 12 very uninteresting garden variety investment options. And I think your point is an absolute spot on one, particularly in this set of the market. The S&P 500 is really the S&P 7 to a very large degree. And with a cap-weighted index, am I truly getting diversification? But then the litigation bar locks the fiduciary up because they're afraid to do anything innovative.
Take your fixed income portion of that, what's available to you. The people who could least afford, they thought they were the defensive part of that portfolio, the 60-40. The 40 killed you. The 60 and 40 killed you in 2022. The 40 was a challenge in 2023. It's a challenge maybe in 2024 as well. But we gave people plain vanilla choices rather than tools to mix things up, because we also don't want to give people too many things. You have 8 or 10 choices. I would argue your fixed income piece could maybe above 6 or 7 of them alone. So we may not even be given enough choices when we put ourselves in the employer's shoes. Is I don't want to give them too many things, because then they'll really be confused. And that too may be the worst.
Yeah, we talked about this whole democratization concept. And I think both in private equity, I think largely the small cap market does not exist publicly anymore. Maybe a bit of an overstatement. It's moved private. And then in the private debt side, a lot of the action is now in direct lending, private credit, and that's all private. And now I've seen some of these large firms like Apollo are going after investment grade. It's very expensive for the banks here in the US, maybe different in Canada. And if that private debt space collectively is 1.5 to 2 trillion, the total addressable market over the next couple of years is probably 2 times that. If now I'm sitting there with the garden variety offerings in the public debt market as a 401k participant, am I missing out even more, not only on yield, but better risk-adjusted returns?
We had done some work on this back in 2022 showing we had used in our fixed income solutions, we basically had said, you're going to need to diversify this. Private credit's got to have a place in there. I'd say forward thinking, Bill, where we're going, if interest rates don't go back to zero, which I don't believe they do, absolute return strategies have a place to play. So think about how I deliver cash plus 3 or 4% with very low volatility. You're going to have to create a different solution in there for the world we're going to. And we did that in 2022 successfully. And so I think when we look at this problem that I see is people are stuck with thinking in tools that may not be the right ones for what they need to get to the outcome and the solution here. Certainly on the private side, I agree with you. Private markets for debt, the banks can't lend anywhere anymore. Everyone's worried about their balance sheets, the capital requirements to lend. And if you're a big company today and you were able to lock up term debt in COVID at very attractive rates, you're locked in at 3 and 4% numbers. If you're the average small company that's private today and you try to go to a bank, you're borrowing at 10%. And so the world is really bifurcated. So we're leaving a bunch of our investors without the ability to have some of those returns in the private market versus that investment grade solution. My last comment, say also as the private credit world, as we've regulated it away from the banks, credit moving into this other place, we've also probably created something that if I'm a regulator tomorrow, I should probably look at. We've moved the classical banking channels and mechanisms into a different world, a darker private world. It may not be bad for private investors, but at some point you have to say, does just the Apollos of the world become the buyout fund of old, become just an investment grade lens of something? I do think mid-market for a lot of things right now, mid-market for private credit, mid-market for infrastructure. I think there are definite return differences there that are available if you can bring product forward that plays in that part of the market, because the Apollos and others will get bigger and we'll leave that behind. So there's an inefficiency as well when some of this starts to come to play.
Yeah, I agree. So, Kevin, maybe wrapping up with a bigger picture observation with some of the things we touched upon and a couple of these points you just mentioned a moment ago. And I absolutely agree that both rates and inflation are not going to touch 2%, maybe even in my lifetime. And I plan on living for many, many years from now. Active management has never mattered more because I think this risk on trade is over. And volatility has been calmer than it should be, but it's going up. You referenced geopolitical risk either directly or by inference a moment ago, and we're long geopolitical risk. And then I think about deficits and debts. And if you look back at the GFC, there's many reasons why that happened, but the first canary that died in the coal mine was when the money market seized up. We have 1/3 of the U.S. Treasury book, $10 trillion, is rolling over in the next 12 months. And I don't think Powell and company are really going to be setting rates. The market is going to be setting those rates. And what that does to the repo market and the potential contagion, and I'm not trying to end this on doom and gloom. I'm trying to say, realistically, these bear markets bite very, very hard, but they don't sustain for long periods of time. And if you could be diversified and see your way through it, I think it's a good thing. And maybe in tying this up to your business model, a multi-strat approach seems to make a lot of sense. And hedge funds and multi-strat have largely been kicked under the bus during this risk on trade. But there are strategies and ways of thinking about this and ways of thinking more global. So maybe getting some of your closing observations on maybe a bit of a mouthful of a question.
You're absolutely right. The world we just lived in the last 15 years post the great financial crisis, we're not going back to. Inflation, we're going to have a hard time getting it to 2. And I'd frankly say that we can all live with 3 as the new world. And no one's going to declare victory on that. It's not a bad world. But that means that the things we were used to just weren't normal. We defined coming out of COVID as getting back to normal as not pre-March of 2020. We said it was going to be like 2006, where you had, and you go back in the history of things, the 10-year yield had some premium over inflation. You're going to have CPI that looks 2 to 3-ish. And it's going to be a lot more volatile. Inflation is not going to be easy to get to 2, even if I'm wrong. And I think this issue about deficits and financing those deficits around the world, just in the case of the U.S., it's going to be a challenge. We are going to be looking at Treasury supply as a factor here, not just the economy. And again, every day that you spend more, you've got to finance that. There's got to be someone attracted to buying and taking on that debt, which means a much higher level of rates than we've been used to. So in that backdrop, volatility is going to be higher. I think we're all served better if we can think about strategies, putting things differently together in a portfolio that give all of our investors an ability to minimize that drawdown. It's pretty simple. When I do this with all of our young trainees, when I have them the summer interns, I have $100 to start the year, the market goes down 10%, and then next year it's up 10%. What do I have? You don't have $100, so you lost $1 somewhere along the line. I think that's the world we have to start to condition people to, is how to think about minimizing the drawdown and really optimizing back these portfolios for a different world than we've seen, certainly for the last 15 years.
And we had done some of these studies early on in Kaya, looking at the endowment model versus a 60-40. And you could talk about survivor bias and backtest as much as you want, but the reality is better risk-adjusted returns, lower vol over time. And if you're going to be tacking in and out every time you get nervous about what the market did in any given day, you're destined to lose. And the smartest investors in the world will tell you you can't market time your way out. So I think this conversation, Kevin, and your model at AGF indicates maybe a flashing light toward staying fully diversified, staying fully invested, and perhaps active management, meaning something now more than it ever has, certainly in the last, going back to the GFC, going all the way back to 2008, where anybody could just show up and buy an index and have done quite well.
You're absolutely right. We do it in practice, but to sit there and think forward about the world we're going to, it's probably more important than many of our end investors realize about the ability to basically just create an outcome, staying the course, but knowing it's going to be a lot more volatile. But if we have the right tools and we think about it the right way, I think we can give people a better outcome.
Yeah, I agree. And maybe putting a capstone on this conversation, I was at the SALT conference in New York this week, and this podcast will probably air a few weeks from now. So this was just last week in May. And I had an awesome panel of the most sophisticated investors, and there was $2.3 trillion of assets across 4 panelists. Now, to be fair, Norges, managing the Norway Sovereign Wealth Fund, is one of them. But I had in your backyard, CDPQ. I had the New York City Employee Retirement System and Fordham's endowment. We talked about various approaches to asset allocation, and it came down to this paper that Kaya put out, Total Portfolio Approach, which maybe not for everybody, but I think if we all could be thinking about that next investment idea has got to be competing with everything else that's already in my portfolio and options I have externally. So it shouldn't be, well, that equity product interests me. Is that better than the infrastructure product or the global macro product or the multi-strat product? And I think that's a lot of what we discussed today. So I think it's great. I appreciate your client-first business model. And if we can get investors to stay fully invested and fully diversified over the long term, I think they're going to do just fine.
Yeah, I fully agree. And if they can do it in a better risk-adjusted way, I think everyone's going to benefit. So thank you again, Bill, for the time today.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.